Lost in a multitude of numbers, graphs, and charts? No time to understand the effect of data such as GDP, inflation, income statements, and cash flow on your investments? Unsure about what's happening to the economy? Don't know the good places to invest? Risk on with equities or risk off with fixed income? Investing nowadays can be overwhelming. There are so many terms to learn and so much data to analyze amidst a sea of investment opportunities. The Atram Global Allocation Feeder Fund is designed to do exactly that. The fund is invested in both equities and fixed, combining the best ideas across the full spectrum of asset classes. Investing in equities that offer potential outperformance while using fixed income to protect against the downside, historically delivering more of the upside of global stocks compared to the downside. Flexible and diversified, it seeks the most attractive investment opportunities that give long-term growth while managing volatility. Portfolio managers and analysts will help you navigate across the sea of numbers, graphs, and charts to find you the most attractive investment opportunities, while you can sit back and relax. All this conveniently available whether you invest in Philippine peso or US dollars. Invest in a fund that gives you competitive returns with less risk. Invest in the Atram Global Allocation Feeder Fund. For more information, visit www.atram.com.ph. Almost everyone has at least one relationship with one financial institution. Practically all businesses, regardless of industry, require financial services at some point in time, be it credit cards, bank and time deposits, loans, insurance, or investments. But financials go beyond these. It evolves through technology, and rapid innovation has given birth to a long-term trend called fintech or financial technology. Fintech is a powerful trend. Electronic payments are steadily growing with a lot of room to grow exponentially. On top of this, we also have the rise of cryptocurrency and other blockchain technologies. With the Atram Global Financials Feeder Fund, investors can participate in growth of companies around the world that are involved with providing financial services. The fund gives you access and diversification to global financial names that we normally do not have locally. The fund also invests in fintech, which a normal financials fund would not. Invest in the biggest global companies in the financial industry. Participate in the global recovery. Diversify your investment portfolio by investing in this fund. Invest in the Atram Global Financials Feeder Fund. For more information, visit www.atram.com.ph.
The world around us is ever-changing. We are facing development challenges on a global scale. Today, 41 million out of 57 million deaths are attributable to non-communicable diseases. In the Philippines, 5 out of 10 families were deprived of basic education. The Philippines also ranked 3rd in the top 10 countries with the most natural disasters. Women participation in the labor force is less than half at 48%, while male participation is at 77%. The United Nations identified and adopted 17 Sustainable Development Goals or SDGs to address the challenges faced by economies, societies, and the environment. We at Atram support the UN and the SDGs by launching the Atram Philippine Sustainable Development and Growth Fund. The fund is designed to invest in Philippine companies that score high in terms of the integration of UN SDGs into their operations and strategy. Through this fund, we hope to encourage PSC-listed companies to integrate UN SDGs into their businesses. We must work together to make a world a better place. Atram Philippine Sustainable Development and Growth Fund. Invest in a sustainable future together. Invest to thrive. Invest together. For more information, visit www.atram.com.ph.
Megatrends are shaping and influencing the global economy: urbanization, technological innovation, resource scarcity, and demographic and social change. The long-term shifts in these trends create multiple investment opportunities. They gave rise to a new type of investing called thematic investing. Enter the Atram Global Equity Opportunity Feeder Fund. The fund invests into the themes that would benefit the most today, making it the first global multi-thematic fund in the Philippine market. Unlike traditional investing, thematic investing is not constrained to sectors or locations, focusing instead on themes and megatrends. It distills the megatrends to find relevant topics that work in this current market environment. It finds the next big thing and invests in it at a very early stage. With this multi-theme fund, investors will have exposure to various companies that will drive future market growth. What's more, you can invest in all the new developments in this world in Philippine peso or US dollar, making it accessible to everyone. Invest in the fund that invests in the stories of tomorrow, today. Invest in the Atram Global Equity Opportunity Feeder Fund. For more information, visit www.atram.com.ph.
Hello and good morning, everyone. Thank you for joining this week's episode of Atram webinar series. I am Therese Angangko. I'm an alternatives analyst for Atram, and I'm going to be your host for today. So, money is one of the most important and crucial part of human life as it plays a major role of our daily livelihood, right? Creating wealth for our future. And investing, on the other hand, is about using the part of your income to invest in various options which will help you grow your money. So in today's episode, we will learn and discuss why investing matters and how the value of money is being eroded in an inflationary environment. So if you have any questions, you may send them as early as now by clicking on the Q&A button below your screen. Inflation has been it's a very confusing concept, and we'll talk about all of that later. So before we begin, I'd like to let you know that this session is being recorded and that copies will be disseminated as well as posted on all our social media platforms. So don't forget to visit our website, atram.com.ph, for more detailed information about all the funds we offer. So open them up right now or scan the QR code. You won't regret it. So if you have any friends who you think would like this webinar but are unable to attend, please feel free to share the YouTube replay of this session and visit our YouTube channel, Atram Studio, or you can scan the QR code here. We'd also like to invite you to join Atram's official Viber community group, #AtramPH Community, to stay updated on all the latest announcements, advisories, reminders. You can scan the QR code or visit the link, and then you can win Atram merchandise. I love that. So we'd also like this webinar to be as interactive as possible. So please don't hesitate to send in your questions in the Q&A tab all throughout the webinar. Each question you send is a raffle entry for a chance to win limited Atram merchandise. So winners will be announced at the end of the webinar. So make sure to stay until the very end. So we'll also have a quick feedback survey as well at the end. So we hope you can share your thoughts and learnings from the session today, so we can always keep improving, and we always want to listen to you guys. So without further ado, I know you guys are all excited. That's why you're here. Let me briefly introduce our speaker this morning, Allianz Global Investors Director, Jason Lim. So Jason is responsible for handling the relationships and business development with various business partners in Singapore and Southeast Asia. So he graduated from Nanyang Technological University, Singapore, with a bachelor's degree in mechanical engineering honors and subsequently a Master of Science in Asset and Wealth Management, where he obtained the Chairman's Award Group. He also obtained a certificate in quantitative trading strategies from Imperial College London and alternative investments from New York University Stern School of Business. So you are all in perfect hands. Hello, Jason. The floor is yours.
Hi, good morning, Therese.
Morning.
Thank you for the introduction. All right, so
Thanks.
good morning, everyone, again. Thanks, Therese, for the introduction. I'm really honored to be here today. All right, to darling from Singapore. Okay, hope everyone is doing well and keeping safe. Okay, I guess today's webinar we are going to talk about more in terms of importance on investing and why investing your money matters, especially in this current market environment. So let me just jump right in, I guess, because we have about close to 20 to 25 minutes for me to share. There's a lot of details, a lot of insights that I'm really happy to do that. So before further ado, let's just go in. So why do we need to invest, I think, and make our money work harder? I think definitely it can be simply due to the financial needs, okay, of life, okay, from buying a home, buying a car, getting married and having kids, forming a family, or even starting work. If we need to buy clothes for our work, even for being a student, okay, because student loans and be better for yourself in terms of studying or even for your loved ones, all this needs money. And of course, right, for those who are very risk averse, they will just tell you, just save more and then spend less. And in this instant, but again, this could be actually done several years back when inflation is still low or insignificant. However, over the course of the last few months or even the recent year, right, we have seen inflation creeping up, and in fact has rise exponentially over the last few months. From the case of the developed nations of US, where we see that their core CPI, Consumer Price Index, has risen to 80.5%. That is probably the highest since August 1982, 40 years ago, right? And even for the case of Europe, okay, inflation has risen to 7.5% in the latest April report. And of course, amid the ongoing Russia-Ukraine crisis and the supply chain disruption due to COVID situation, inflation is expected to go up even higher. And this has definitely affected this part of the world in Southeast Asia. So in this slide, I have used Singapore statistics, okay, but I guess this is definitely a very similar case in Philippines as well. In fact, in the latest Philippines Central Bank's report, okay, we have seen that the latest inflation has already hit the upper bound target of more than 4%, right? And of course, banks like Banco Central Filipinas, the central bank has also expected that inflation will continue to accelerate further, right, in the medium term due to the current disruption of the supply chain. So prices from your daily necessities of bread, eggs, and rice have also increased, and even electricity. I think definitely this is the case where the Manila Electric Company, right, has hiked power rates, the utilities cost in March itself. So inflation is a double-edged sword, right? In fact, if kept at a low level, it is a good sign for stable and growing economy. So as the increased consumption and slightly higher prices for goods and services can bring about better profitability to companies and eventually the stock market doing well. However, if inflation gets too high like what we are experiencing right now, we do see that the value of our money is being eroded much faster. Here, I have used a hypothetical example. In fact, if you have 100,000, right, you can see that with just 3% inflation, and definitely right now we are looking at about 4% in Singapore and in Philippines, okay, we are seeing that the value of your 100K will only be left with 3/4 of about 75K, okay, after 10 years. So, in fact, this is where you can see that for those who have choose to just save and not do anything about it, okay, it is really a sure way for you to lose the value of your money as each day goes by. So not doing anything to counter the effect of inflation isn't an option anymore. Before I move on to the second segment to share about what investment solutions that could be considered for investors in an inflationary environment, I think I want to reinforce the case on investing using this 8 wonder of the world, right? So I'm not the person who actually called this the 8 wonder of world, but in fact, a very famous wise man, even possibly the greatest investor in our time, Albert Einstein, is the one who actually quoted this. Compound interest is the 8 wonder of the world, and he who understands earns it, he who doesn't pays it. So really like to spend a couple of minutes on this effect of compounding. So compounding interest is basically the interest earned on the interest, right? Which is also known as the snowballing effect, as quoted by our investment guru, Warren Buffett. So I've shared an example here. Imagine if you are earning 4% interest on your $100, okay, invested at the start of probably, let's say, 2022. You will already get $117, 116.99 to be more precise, at the end of fourth year, because of the 4% interest earned on interest accumulated annually over the last 4 years. Hence, it is never too late to start investing, and preferably to start as early as possible, so that investment will be able to compound over time, snowball over time, to give you greater returns. Something related to the compounding effect is this called Rule of 72, which I believe many of you probably have heard of. It is a way whereby it can help you to estimate the period whereby how long your investment can double at a given rate. So when you divide 72 by an interest rate number, okay, you will get, or the rate of return, you will get the number of years required to double your returns. So in this example here, right, if the interest rate or the rate of return is 4%, right, 72 divided by 4, okay, will give you 18 years. So you can in fact double your money within 18 years with a 4% interest. So again, I would say that definitely if the rate of returns is higher than 4%, then it takes a shorter time for you to double your investment. Having said that, all right, I'm not advocating to put all your investment in a high return investment solution. Not putting your, as they said, don't put your eggs into one basket. And of course, do not just go for the high return, because high risk, high return. Thus, it is prudent to know what you're investing before putting your money at work. So now, in my second segment, I would like to share with you the possible, potential solutions for investors in a inflationary environment. So this inflationary environment is expected to continue, as I mentioned earlier on, and this is somewhat concurred by the US Federal Reserve, just a few hours ago, right, whereby they have hiked the interest rate again by 50 basis points, and they're expected to do so for the next few upcoming Federal Reserve meeting or FOMC meeting. And in fact, in terms of asset class, right, we do see that the traditional investment grade or the government bonds that's boxed out in red here in the form of US Treasury, which typically tends to be considered as a safe haven or safe investor, might not be as safe in a rising rate environment. Okay, as highlighted here on the red box, they tend to decline in a rising rate environment. Again, why is it so? Right? I think just really bring back to the bond 101 theory, okay, the theory of bond duration. So what is duration? Duration is a measurement of the bond interest rate risk, all right, and is a measure of a way to measure how the bond prices will react or change when interest rate move. And here on the extreme right hand side, top right hand side, you can see that there's this lever or seesaw. Okay, when interest rate rise, okay, we expect the bond yields to rise, and because of the inversely correlation between the bond yields versus the bond price tends to fall. Here I have quoted some hypothetical example, and in fact, for US Treasury, they tend to be 10 years or longer duration. All right, if the bond prices, if the rates does goes up by 1%, we are expected to see a negative 10% in terms of a bond price downwards, which is definitely not ideal for many of the risk-averse fixed income investors, right? So, what are the asset class that would do well in a rising rate environment? Okay, I would say that definitely in this case, it is some of them that I highlighted here in the green box, like for example, equities, for example, convertible bonds, and of course, high yield bonds, which tends to be of shorter maturity due to the higher yield that they offer. So let me just take you through to the each single asset class to highlight the case for this in a rising rate environment. So for equities, right, equities have historically proven to give good returns when inflation is there and moderate, okay, because higher prices can lead to higher earnings to companies, and therefore investors tend to pay more for higher earning growth. I think this is definitely not ideal for us as consumers, but as investors, it is prudent to invest in good quality companies that have strong pricing power and can pass off the higher costs to their consumers. So in terms of earnings growth, after bouncing back strongly in 2021, corporate profits is expected to continue to grow, though at a moderate level. And according to the market consensus, we are seeing that earnings is expected to trend higher, likely to be a high single digit, right, for 2022. And this will definitely help to propel in terms of the share prices for many of the companies itself. Also, I would say that it is prudent to worthwhile to look at companies that have a good cash flow and strong balance sheet, because again, with a good cash flow and strong balance sheet, they are able to tide through any market cycles. Moving on to the next asset class of convertible bonds. So what is convertible bonds? Convertible bonds is basically hybrid securities that combine the features of both stocks and bonds, and they are typically issued by companies as a form of debt, right? So similar to other bonds, convertible bonds provide a coupon income at a fixed rate. However, because of this equity warrant that is in the convertible bonds, investors may convert these bonds into stocks when the share price rises to capture the upside potential of the underlying stock. So here I have showcased in terms of this schematic illustration of convertible bonds. Okay, they allow the case of providing investors both the advantages of a bond, which is to protect the downside while getting a good income, but at the same time, they also give investors this upside participation potential when the market actually rally. So, for example, when the stock market is doing well, investors can convert these convertible bonds, which has moved in terms of the price just along with the equity market, to capture the potential upside, right? However, when the stock market is doing poorly, because of this cushioning effect, right, investors can actually hold on, right, to these bonds and enjoy a stream of potential income. So overall, convertible bonds offer a symmetric return risk profile as they will provide a return that is comparable to pure equity but at a lower volatility, as you can see on the top left-hand side. Okay, so this showcases to you the past performance of convertible bonds index versus the equity index of S&P 500 over the course of since 1988 to the December 2021. Right. And of course, due to the lower correlations of convertible bonds towards US Treasury, convertible bonds tend to do well when US Treasury is in a negative territory, like for example now, whereby the rising rate environment, right? So moving on to the next asset class of high yield bond, as the name implies, high yield bonds actually offer a higher yield than their investment grade rated counterparts. The credit ratings of high yield bonds are lower than investment grade. So typically based on S&P, right, ratings, it is double B or below, right? And of course, with that, they tend to offer a higher and more attractive yield compared to the investment grades or the higher ratings issues. And of course, for the past few decades, we have seen very strong growth in this asset class of high yield market, right, which makes it a very popular investment instruments right now. Let us now address some of these concerns for high yield bonds, because one of the key concerns is the default rates, is the credit risk. So as seen in this chart, which is highlighted in blue, the current default rate is now about 0.3, okay, which is largely contributed to by the poorer quality of the triple Cs and below issues. The reason for this low default rates of 0.3 can be attributed to the strong economic fundamentals and of course more importantly to the improved corporate fundamentals, whereby taking on the left-hand side, top left-hand corner, leverage, the debt level has decreased for companies, for the issuers, while the interest coverage ratio on the right-hand side, the top right-hand, has increased over the recent years. Another contributor will be probably in terms of the revenue and the earnings, whereby they have been improving over the last couple of years. So all in all, the credit fundamentals of companies issuing these bonds are healthier and better. That's why contributing to a low default rate of 0.3. Within the high yield bonds, of course, there are the good chips and the bad chips. So in terms of that, we do think that the higher quality of double B and single B tends to be the better one compared to the triple Cs. Why? Because they give a better return versus risk, right? Yet at the same time, they are lesser volatility, lower volatility than the poorly quality of triple Cs. So in summary, okay, I just want to take you through what I have just covered over the last 20 minutes. Okay, low yields, fears of both equities and rate volatility are going to be part of the current market environment. Okay, but with rising inflation, sure thing that you will see the value of your wealth eroding faster if you don't do anything to it. Right, just putting it under your pillow or even putting it in your deposit, which is not yielding as much, will not be able to help you to counter off the effect of inflation. So there are several asset classes to invest in an inflationary environment, namely number one, high yield bonds, because they give an attractive income in times of a still low yielding environment. Convertible bonds, because again, they form a symmetric risk return, which allows investors to participate on the upside of equity market while also having that kind of downside protection from market volatility. And lastly, equities, which tends to provide the case of capital appreciation potential. So all three of these asset class can actually form a good diversification while providing investors with a good source of potential income to give you both income and growth for your investment, especially in a rising rate environment. So with this, I hope that I'll be able to give you a good and clear perspective of the insights of importance of investing and where to invest in the current market environment. With that, I would like to pass the time back to Therese.
Thank you so much, Jason. I really learned a lot, definitely. And it was quite technical, actually, some of your slides, but I think everyone will appreciate in the long run. I always had that mindset as well, like you should spend less, save more, but like you've proved to us, it's just not going to work. We really do have to save. So with high yield bonds, convertible bonds, equities, we do really have to invest. And there's so many avenues to take advantage of. So thank you so much. Atram has a wide range of investment products, and our capabilities span across several asset classes meant to service these different investment objectives of each individual. And Jason has, shown to us these different types. And with these, it is with great pride that we announce that Atram has recently won Best Investment Solutions Provider Philippines 2022 from International Business Magazine Award and World Business Outlook Awards. So for today's session, we hope we somehow assisted you to hashtag Take On Tomorrow by investing your hard-earned money with an award-winning fund house. So at this point, we'll move on to our live questions from our audience. We know we have a couple, and we kind of rephrased it a bit to keep it a lot concise and consolidated it. So Jason, first question, I think a lot of people are asking, how can beginners make sure that they're not going to get scammed? I mean, we saw your credit ratings, and they get confusing for sure. So what are like your tips on that?
I guess definitely the key thing is to know what you are investing into, and you need to do your homework. And you do not just take others people's word for it, even if, let's say, for example, research reports that is published, right? You also need to do your homework whether this is actually suitable for your own investment appetite, right? Doesn't mean that it's being published by research brokerage firms. It means it's good because sometimes it does not fit into your investment appetite, right? So I think definitely back to my point is that you need to know what you're investing, and sometimes, as I mentioned, if it is too good to be true, then it's probably the case. So just have to be aware.
Right, that's so true. What do you think are like other asset classes that are high conviction bets in a rising rate environment with geopolitical risk? And I think that's where we kind of are right now. So it's everyone just doesn't understand where to go.
Yeah, that's true. Okay, I guess I've shared earlier on in terms of high yield bonds, the scored and convertible bonds, as well as equities, right? That could be actually considered for inflationary environment. I'll not rehash that, but also at the same time, I think more towards the case of within the case of equities, okay, or even bonds, you can see that on a topical or thematic investing is probably something that could be helped to weather through these market cycles. Because again, thematic investing is being more supported by the long-term structural change. Okay, like for example, in this case, we do have seen some of this like digitalization. I think because of COVID situation, we have seen that digital has been a part of what we are doing right now. I'm talking to you via Zoom. This is one thing.
Right, yeah.
Yeah, and of course, other than that, we do also see that there's a changing demographic in terms of our population. Okay, it's aging population. So, and of course, healthcare is one thing that tends to be a bit more focused. Other than that, I think climate change, okay, is one key aspect. Okay, because we know that we have done quite considerable harm to the earth since the humankind comes about. So I think it's time for us to pay our dues and actually helps to protect the earth so that our next generation will be able to enjoy what we have done so over the course of the last few decades or centuries. So I think, again, back towards the case of thematic investing, this tends to be something that is more supported by a long-term structural growth. And of course, they tend to be more immune to any of these short-term market fluctuation. So that's for equities. Maybe in this case for fixed income, I think probably one other thing I highlighted about shorter duration. Okay, I highlighted about avoiding long duration like US Treasuries. I think another key aspect that investors can be considered for fixed income, which I would say is not traditional, is somewhat called the floating rate note. So, or in short, they are called floaters. Okay, what do they do is basically they have a coupon that is adjusted according to the interest rate environment. So this could be something that's attractive, okay, because we have seen that the Federal Reserve yesterday they have again hike the rates and expected to hike even more over the next few months. And then probably Europe, ECB might also do so in second half of the year. So this global floating rate note of floaters could be something that provides investors with a benefit of rising interest rate environment, yet at the same time be able to give them that kind of assurance, especially in terms of credit risk, because if you buy into a floaters, which tends to be investment grade floaters, they tend to protect the downside in terms of credit spread widening. So these are probably some of the things that I can share with other than what I presented earlier on.
Yeah, that's actually so insightful. I'm gonna have to watch this video again to remember what you said. I think everyone should do that too. So I guess this. I guess for a lot of people here, they're concerned, right? Of like, does investing require a lot of money, and how long should they stay invested? I think that's a lot of people's concern.
Okay, that's a very good question. I guess investing doesn't require a lot of money. I think you can just start with $100. Be whether because you can start off with a regular savings plan or maybe some places they call it the money investment plan. So this could be something that doesn't require a lot of money for a start. It's just really again back to the second part of the question, how long should you stay invested? I would say as always, as long as possible, because again it is time in the money, not timing the market, right? So time in the market rather than timing the market. A lot of times people will think that, oh, is it a good time to invest into this market right now? Am I buying at the market low, right? I think timing the market is always very difficult, even for us as an experienced investment management manager, which we have done it for so many years, right? Timing the market is always difficult. What we really advocate is time in the market, because again brings back to the effect of compounding, right? To make your money work harder, to let your interest grow on your interest, especially in this inflationary environment.
Right. Yeah. I think that's always a good reminder for everyone. For myself as well. I always get stressed. It's like, okay, it's low, let's go. But you just gotta be patient.
Yep.
Okay. Next question. Ooh, it's an interesting one. How can you take advantage of these two concepts, which is debt and taxes, in investing?
I'm not really clear in terms of what does it mean, the concepts of debt and taxes when it comes to thinking about investing. So I think in terms of debt, I think I will address that in terms of debt, right? Again, debt is like, for example, issued by companies. So I've highlighted a fair bit here, from the high yield bonds to the floaters. Okay, I think this is definitely something that could be considered, especially in the inflationary environment. Okay, because high yield bonds, they tend to give a higher yield. Okay, and especially right now, the credit fundamentals of the companies, the debts that they have issued, it tends to be healthy, because the company's fundamentals are much better than 2 years ago or 3 years ago. So this is something that they can capitalize. And of course, with the higher yield, you are able to cushion off, right? You have a higher cushion in terms of the price volatility. For clients who think that, okay, I don't mind, get sacrificing a bit of returns, in terms of bonds, in terms of debts, and I will want to probably not go to the higher yield bonds. I will want to move on to something safer. A floater, investment grade floating rate bond or floating rate note could be something that could benefit, because you are getting this protection from credit risk, as well as at the same time, instead of being compensated for this interest rate volatility, you are being benefiting from that, because as interest rate goes up, the variable coupon actually adjusts by itself. So this could be something that I will say that when it comes to talking, hopefully this answers the questions of the debt concept of debt when it comes to investing.
Yeah, definitely. I hope whoever asked it, your question was answered. If not, just keep asking. Everyone here, just keep asking questions. Jason has all the knowledge in him for sure. And we'll get to those questions. So just keep asking them. Okay. Our next question here is, where should we be where should we be investing more aggressively in? Global or local stocks? I think that's a tough one for some people.
Ah, okay, that's an interesting question because again, I'm not sure whether what's the definition of aggressive. Okay, I would say that it really depends on your financial needs. Okay, when it comes to talking about the geographical area. So if let's say, for example, okay, of course, doing a global investment, you tend to diversify much better. Okay,
Mhm.
because that's the effect of diversification again. And but again, I would like to say if let's say you have an immediate needs or short-term needs for your local currency, then probably investing local will be helping out because then you will be not so subjected to the foreign exchange movement
Right.
between your local currency and probably the US dollar or even the euro or even the Chinese yuan that you're invested into.
Mhm.
Yeah.
Mhm. Oh, that's so true. Yeah, that's definitely something that people have to take note of and follow. Because not you don't only have to follow your stocks, but you also have to follow the currency. Oh,
Yes.
oh. So yeah. Okay, then our next question is is invest how important is investing and in what market best to invest given the volatility of the market this time of the pandemic? Oh my goodness, sorry, that question was a lot. So how important is it to invest and what market is it best to invest in given the volatility of the market of this time of the pandemic?
I would say that is something that I have actually highlighted, but I don't mind answering that again. I guess importance of investing definitely very important. Okay, because especially in the where inflation is so, I would say at such a level right now. Okay, because again, if you don't invest and you decided just to put your money into cash and do not do anything, one thing that you'll be very sure of is that the value of your money will erode because of the rising inflation. Okay, I've actually shared earlier on that if you would just put if you just have a 3% or 4%, okay, sorry, 3% inflation rate, right?
Mhm. Yeah.
Then in this instant, okay, your 100,000 will lose a quarter of it within the next 10 years. So I think
Mhm.
this is definitely true because we have done a lot of back testing right now over the course of the last few decades to actually showcase that. I think that is why again it's very important to make your money work harder. All right, but again, I'm not highlighting that the case of aggressively investing into one instrument or one asset class because again we need to highlight the case of diversification and definitely
For sure.
brings back to the first point, all right, of what Therese you have asked in earlier on is that um, how do investors be making sure they're not scammed. So I want to really highlight the point is that you need to know what you are investing. Okay, that is really important, and of course you need to know where your investment appetite is, right, when it comes to investing.
For sure, definitely.
Yeah.
You also talked about convertible bonds and high yield certain asset classes. So we were wondering like what fund can kind of like capture this for people who want to get into these things, but they don't know where to look.
I guess I'll leave the fun recommendation to Atrium to talk about this because I'm not in a good position to actually share about this in this webinar. But I guess again, we wanted to highlight that there are few asset classes. There are definitely a few solutions out there, especially in this current juncture. I think I've shared about it. Equities, convertible bonds, high yield bonds, even floaters could be something that
Right.
investors might want to consider in this current environment.
Right, for sure. And I think Atram actually does have some of these things that you're talking about, which was the
Yep.
US multi-asset income feeder fund. So they do have a bunch, and all of you who can go to Atram Prime right now, you can check out their prospectus. It's like a one pager, and I think that's what the due diligence we've been talking about, doing your homework, reading what's in these funds. Um, and yeah, I think that's so important for everyone. So thank you so much, Jason, for the time. I learned so much, and I'm part of Atram, and I already learned so much more than I thought I already knew. I have to rewatch all about your convertible bonds, the high asset yield ones. Definitely, I'm gonna rewatch this. Thank you so much. Before we wrap up, any last words, Jason?
No, I guess really stay safe, everyone, and of course invest safely. That's more important. Yep.
Yes, definitely. Simple, keep it simple. Once again, thank you so much, Jason.
Thank you,
And of
Therese.
course, thank you to our audience. We appreciate you taking the time to join us today. And we hope you were able to gain some key insights and takeaways from today's webinar. And so, now, did you know for as low as 1,000 pesos, you can already jumpstart your investment journey? And here's how you can invest in Atram funds.
Good day. If you are interested in investing with Atram, the leading independent asset and wealth management company in the Philippines, please visit our website, www.atram.com.ph. We have all the details you would need to know about our funds. If you would like to start investing, click Invest Now. For further assistance and account opening, you may email our client services team. If you have more questions, visit the website's Frequently Asked Questions page or Atram Academy page. We hope this helps. Thank you.
So there you go. If you have any further questions or would like to learn more, go to atram.com.ph. Please open up now. It's super easy. It'll take 5 minutes if you haven't signed up already. For our next webinar series, please join Atram's Chief Executive Officer for Asset and Wealth, Mr. Philip S. Hagedorn, for an exclusive conversation featuring Robinson's Land Corporation's Chief Executive Officer, Mr. Frederick D. Go, as he shares his perspectives on leading with a purpose, as well as insights on the future of the real estate sector and why the country continues to be resilient during these unprecedented times. So, in case you haven't registered yet for this webinar on May 19th, you can do so. You can scan the QR code. You can also type in the link flash on your screen. So, and you all know our social media pages, so please join us. Again, if you have any friends who you think would like this webinar but are unable to attend, feel free to share the YouTube replay of the session, because I know I'm going to be replaying it to hear all about the convertible bonds again and the high yielding assets, because it's a lot to take in and to understand. So visit our YouTube channel, Atram Studio, and scan the QR code. We'd also like to invite you to join Atram's official Viber community group, #AtramPH community, to stay updated on the latest announcements, advisories, and reminders. So, daming QR code, but it's worth it. So lastly, please answer the survey at the end of the webinar. We would love to know your thoughts on today's topic, and we'd love to know what you guys want to learn more about. So on behalf of everyone at Atram, thank you again for your attendance and participation. We wish you and your loved ones continued health and safety. Have a great day. Please invest today.